talking markets, and who better than Manish Chokani, one of India's most respected market voices, a veteran known for his deep insights into global cycles, capital flows, long-term investing. In fact, Manish has got a knack for connecting the dots between macro shifts and market behavior, offering clarity at times of uncertainty. And, well, we're at the peak of uncertainty right now, shall we say that. Today, of course, we're going to be getting perspective on where he thinks India stands in this very rapidly changing global investment landscape. Manish, hi, morning. Great to have you on the show and good to see you after a while.
Yes, good morning. It's been a long time. Good to see you.
It has. And, you know, I often think in my head the quote that you introduced all of us to, that there are decades when nothing happens and then there are weeks when decades happen. And it really seems like that kind of time right now.
It's always the case, no? When the world is in a reset mode, there is a lot of stuff happening. Yeah, sure. So
Yeah,
let me just wait for your questions.
absolutely. And you know, let's first, Manish, talk about these global shifts in capital flows that one is seeing. You know, we're witnessing this massive global reset, as you call it, from the AI mania that is lifting tech valuations to capital flows moving into Europe, into China, and even a sharp pickup in allocations in hard assets like gold, silver, uranium. How is it that you're interpreting these shifts, and what do they signal to you about investor behavior and psychology?
So it's a great place to start, and thanks for the question. We spoke, I remember, I think 6 months ago, that the world's been in this midst of this big shift away from the US-dominated Second World War architecture. And that geopolitical chessboard is, of course, still being played out. And in that vein, what the president of the United States is trying to do is, of course, draw back money into the US to solve his trade deficit, to solve his fiscal deficit, and so on. We may not agree with the way he's going about it, but clearly someone needed to fix the US financial position. And while we're all waiting and seeing the inevitable decline of the dollar, the fact is the world really doesn't have an alternative. So what's played out, of course, very famously is this whole tariff situation where he's browbeaten his allies in the UK and in Europe and in Japan and Korea to basically fall in line. And of course, India is being at the receiving end because we could not afford to fall in line on some of the things which were asked for. But what it's also meant for us is that a lot of the FDI in the world, which used to be outbound and going into markets like India, has suddenly frozen. And it's being directed back at presidential diktat into the US, which has, of course, implications for our current account. The second, of course, is this temporary issue, I think, of the tariffs, which is hopefully going to be settled over the next 3 or 4 months, I would imagine, which is also what the markets here seem to be taking in their stride. But in the meantime, the world seems to be in the middle of this incredible mania in AI. And if you don't have an AI play, nobody's really interested in you. So whether it's the big six US stocks, or indeed money has started flowing out even into China, which was not a very favored market, into stuff like that ever since DeepSeek came out. So people are just so starved for growth that one big area has become this AI field and everything ancillary to that, whether it's data center or energy and so on. And the second big move, of course, has been away from the dollar into this hard assets, as you rightly pointed out, where you've been in an incredible bull market in gold, silver, and even metals like uranium, which are also an ancillary play into the whole energy theme. So that's the sort of the lay of the land in which we are living. And India in the middle of this is, of course, in its own kind of elephantine walk, dancing to the tune of its retail investors who are just pouring in this $3 billion a month into the markets. And we're still an expensive market with, maybe 9% type headline growth in earnings and trading at 20-21 times. By no means a cheap market. And it's a discussion we can have as we go along on, what the alternatives are for global investors versus how, Indian investors are positioned.
Come to that, but you've given our viewers a lot of food for thought, so let me take it one by one. Let's talk about India versus the US valuations, right? Because India is trading at around 21 times forward earnings with only 8 to 9% EPS growth. while the US, despite its massive size, is delivering close to 25% earnings growth. Do you believe India's valuations are still justified? Or do you think we're at a risk of being structurally re-rated downwards?
So, well, the Indians have been buyers at the margin in India, right? You've seen this incredible amount of foreign selling. And to just put in context, I'll share some numbers people think it's very patriotic to only look at India and not look elsewhere in the world. And we've sort of become frogs in the well, I feel. But to just put in context, the big six US tech firms, not Netflix and not Tesla, but the other six, Nvidia, Microsoft, Apple, Amazon, Google, and Facebook. Last year, I think 12 months trailing, have made a profit after tax of about 500 billion US dollars. The entire Nifty 500, I think, makes less than $200 billion, just for context. And these guys will probably be at 600 billion, just these six companies, next year in aggregate. And they trade between 20-25 times. So if you're, a large money manager in the world, and you see something which is game changing happening in the world, growing at 20-25% on that size, would you rather put money and own, Amazon, or would you, own India? And that's the sort of trade which seems to be going on. Secondly, even if you don't like the US, you've seen for 20 years now that gold has kind of tracked the returns of the Indian equity indices. So would you rather be in gold, or would you rather be then in the Indian equity indices? And therefore, when you come down to India also, you realize the problem that we've hit on the Nifty, that a lot of our favorite sectors, like IT, Gautam was talking to you before I came on. It seems to be the case that the next 2-3 years will be like Y2K moment, where the Indian IT sector has to organize the data sets for people, so that then the AI can start using that data to make these companies a lot more productive. And again, just to put in context, while the Indian IT sector also trades at 20 times, and they are probably growing at 5-ish%, something fantastic is going to happen in the coming year, 2027, where I believe the profits of SBI will cross that of Reliance. The profits of ICICI Bank will cross TCS, and the profits of Axis Bank will be crossing Infosys. And that kind of dramatic shift which is happening is going unnoticed in the market because of this whole narrative of banking has slowed down, NIMS and capital market plays and so on, which is of course also a reality. But this composition of our index is slated to change very massively. And these new age companies which are coming in, and again, I may not agree necessarily with all the valuations, but the index of India will also have to go through some kind of reconstitution over the next 2 years. And therefore, most of the action which is now happening is happening outside the index, or it has to take place eventually in the financial space, whether it's banks or NBFCs or capital market plays or insurance or what have you, and of course the tech names within the financial space as well. So that's the sort of way one should presumably think about what's going on over here.
Interesting. So you're saying whatever advancement is being made, stick to the financial link of it, be it banks, be it NBFCs, and even tech, which is all related to fintech, rather.
See, think of it this way, Aisha, that who is the biggest beneficiary of AI? Like it was when the internet came, people who needed connectivity, like for example, I used to run a brokerage back in the day, and I got distribution access to everywhere in the world, and I got clientele everywhere in the world, and we benefited. So even when our rates dropped, the volume of business expanded so massively that we all benefited from it. And you're seeing the trend with people like Zerodha and Grow and others now coming up and doing retail broking on a massive scale, which is actually lifting off our markets over here. But from a productivity perspective, which is now what this AI is going to lead to, the biggest users of kind of qualified data are actually the financials, because they're just sitting on enormous data. I mean, you look at your screen, it's just filled with data. And as you start applying a lot more intelligence to it, you don't need to have so much human intervention anymore. So while the coding need for the IT companies is going to go down, the usage of AI in the financial space is going to be going up and make them a lot more productive. And therefore, these cost income ratios of these banks will not remain at the levels they are today. because today they're taking the peak of manpower costs as well as the peak of technology costs. And as this starts driving down, and at some point in the cycle, as you can't keep compounding 25% on all the stocks we love in AMCs and exchanges and so on. Money does come back in a cyclical turn back into fixed income, and banks actually end up owning all the insurance companies and the AMCs and so on and so forth. So while the capital market plays on a secular basis will probably outperform in pure earning terms, maybe by 30-40% compared to what banks do, but their valuations are also capturing that today. And again, I'm saying this as someone who has stakes everywhere in this entire space. But it is a space which I think should be central to any investor in India on a disproportionate basis. Even I would argue beyond what the index is holding, precisely for this reason, because we don't really have a AI play. We don't have a technology play. We are just kind of providing the tools and shovels and not really picking up anything more than the pennies over there as yet. But the beneficiaries, like I said, of this AI data usage is sitting right in front of us. And that's really the crux of the argument.
What about the underperforming segment? I mean, where is it that you think derating would come by? Would it be FMCG, IT? Could it
Yeah,
be
I mean,
pharma? They have been underperformers. They face question marks on growth, visibility. Do you think these sectors are headed for a further slow derating, or they
I
offer a
mean,
contrarian opportunity perhaps for the
no,
patient ones?
no, your question is right that from time to time you get trading rallies in what are structural bear phases, and you'll get that from time to time. But if you were to tell me that will you know the Indian IT services sector, the way it operates today, if they don't radically change the way they operate, will they be as relevant as what they are today? And I really honestly wish they do make that transition because they have been kind of the big export drivers for India. And India would not have reached this stage on the global map if it were not for our IT sector. And they are, like has been famously said, what oil is to Saudi Arabia, the IT sector has been to India. But they really need to step up a step change and go from being processors to becoming actually owners of the IP and tech. Uh, and even if you look across China, it's not just the Americans who are doing hundreds of billions. You see the Alibabas and the Tencents and the JDDs, PDD, even BYD is actually now a tech company with software inside it. We've clearly missed a trick, on that front. So a slow derating of these companies, if you keep growing, single digit or low single digit, you will not keep enjoying these kind of multiples. And the same argument applies to FMCG. While there's currently a lot of excitement because of these GST cuts, the fact is they are low growth companies. We actually did a study for 2013 onwards for the last 10 or 12 years. There've just been two global companies in China, one called Quecha Motai and one in Europe called LVMH, which of course you will know very well. These were the only two which grew more than 5%. So there's been such a lack of growth on innovation in these consumer type companies, which were market darlings in the period before that it is a slow derating. You can't be running on 40-45p multiples for growth which is being delivered in low single digits. So FMCG clearly is in a problem. IT clearly is in a problem, and even Indian pharma, which again the analogy is with the Indian IT services sector that we remain trapped in just doing generics. And US pharma stocks, which are the fountainhead of innovation, they are now trading. I'll point out, for example, Bristol Myers or even Merck, and across the Atlantic Ocean is GlaxoSmithKline. They trade on single-digit multiples. And even if I look at the quasi-innovative companies like you can think of J&J or even Roche in Switzerland, which are the leaders in cancer and diagnostic and so on, they trade at 15 times. And we are buying generic stocks here when there's a patent cliff and there won't be a lot more generics to launch on these 25 multiples. And I know a segment of our market is very excited on this whole CDMO play. It's because these chaps are outsourcing the risk to you and you are carrying the fixed costs. And if you hit something, it makes a difference because we are the micro caps in the larger scheme of things. We're not going to be the next Eli Lilly or the next Novo Nordisk coming out with an innovation over there. And that's really where the profit pools are moving to globally. So, I mean, overall, as a country, I think we need to change our game a bit from being this very process oriented, and we've spoken about it a lot in the past as well, that we have to find IP companies, brand companies, technology companies, which are actual technology owning or brand owning companies, which can then globalize from here. So that's what I keep occupied with nowadays.
It's going to take some time, right, Manish? I mean, those opportunities, if at all, A, are not the scale of your LVMHs or Eli Lillies just yet, and they're not listed.
So again, you'll remember we've been speaking what for the past decade, and for the past decade, I've been shouting that the fun for India is where these young Indians, we are entrepreneurial, and the money is made by going and building businesses. And if actually you look now across the market cap ladder, maybe company number 120 would have the promoter would have as much wealth as the richest guy in the stock market who's a legend, who may no longer be with us. But true wealth has got created by people who've gone and built businesses. And even for us, a lot of the money which has gone made in companies which before they came to the markets. Because as you're seeing with all these private equity players, they are coming and selling to the market at top dollar, leaving very little for you on the table. And indeed, most of the smart money, whether you look at the strategic investors from US, for example, General Electric has sold down its stake in India, Whirlpool has sold out its stake in India, BAT from UK has come and sold down its stake in India. Of course, all the famous Korean stocks, they're coming and listing in India and selling down their stakes to get valuations. You've seen Singapore Telecom coming and selling down its stake in Bharti Telecom. So entire region, and even promoter holding in India, if you've seen the stat, I think we are down to private sector promoter holding is down to 37% in aggregate. So they've sold about 7-8% of their holdings also into the market. So if FIIs have sold, private equity has sold, strategics have sold, it's really Indian retail through our mutual funds, which is it is growing at 9%, and we are paying 20-21 times for that. So on an aggregate basis, this is not a market to go shopping in. Whatever you've bought, you can stay the course to see through the whole cycle. But things which get super expensive, I've again spoken a lot in the past, you sometimes take a decade to just catch up on that valuation and start compounding from there. And this market's even over 20 years, I mean, I keep saying you basically double every 5 years, and you quadruple. So there are periods like the last four years were incredible. Then last year, of course, we went nowhere. But that kind of compounding, it needs a time to kind of breathe and stabilize and then re-accelerate and get back up. And we are thinking that sort of holding period as we speak. Last year has not been great for the markets, as you know. And even now with a 9% projected earning trajectory, it's telling you that action was required, which is why you see tax cuts from the government, you see GST cuts from the government.
I didn't get that.
You see
Could you try
interest rate
again?
cuts. Clearly the country needs some new growth engines.
It sure does. But Manish, there is that other pocket also, which in the last 4 years has made investors so happy, provided you got in at the right time. Food delivery, QSRs, defense, EMS, travel stock. They seem to be, kind of priced for perfection. What's your take here on whether these sectors can sustain these kind of multiples? And some of the stories are not even making money. You know which ones I'm talking about. Where do you think the next phase of this sectoral leadership in India will actually emerge from? And will it continue to be some of these sectors which will still be at the top of the rung? Or do you think the best is behind them?
So we've spoken, right, about this as well in the past. That I remember when Apple came to India, I said this was kind of the Maruti moment for EMS as a space, that this would just take off with the government putting its, force behind them. And then a company like Apple coming in, and you'll notice even in the US tariffs, electronic exports from India have been excluded basically to help Apple, and that's really helping India as well. So that space looks like it will keep compounding 40%, but the multiples are, sadly north of 100. In at least, the leader Dixon, if I remember, and nothing against them, but we've all been fortunate to participate in all these names. But, I think there's a time and a price for everything. And they are priced a lot for perfection. And now with the Tata Semicons coming in and the Microns and the others coming in, it is going to get a lot more competitive. And this is not, how do I say, a high free cash flow business. It's a capital guzzler. You have to put a lot of capex. You need a lot of working capital. You need a lot of employees. So which is great for the economy. But how do I say, it's a bit like the airline business, that you need very high capacity utilization rates and high growth rates to keep going, to keep everyone interested. And as you've seen in the airline stocks, the promoters keep cashing out money and they dividend out everything, so they don't leave anything in the balance sheet. So if and when something hits the wall, it's really a problem for the bankers and the residual shareholders. So not suggesting anything like that is due to happen, but valuations are something which we grew up learning the Warren Buffett way, that rule number one: don't lose money. And some of these look like that. Even this whole food delivery space, or QSR, I saw in aggregate the entire QSR market cap is say 10 billion, and in aggregate they make 100 million post-tax profit. So even that's like an aggregate 100 p sector, and it's being priced for in infinite growth. And surely they will grow, but when your starting base or valuation is where you are today at 100 times, something clearly is off on the investor radar. Food delivery similar. I think aggregate market cap for that space is now 50 billion. It's not a joke to deliver earnings on that base, which justifies say a doubling from here even in 5 years to 100 billion. The sector will probably have to make like maybe at least $3 billion of post-tax profit. So again, it's a great space. The momentum is there now. The earning compounding from a non-existent base will look very high, but in relation to absolute market cap, some of these make no sense. But let me turn it around the other way. Like you asked for neglected sectors, because of the giveaways that the government has done, I think time has come, and the finance minister alluded to it, that non-strategic disinvestment, privatization, call it with whatever word you will, could be back on the agenda. And if you do have a couple of these going through like IDBI, and then there'll be excitement on all the NALCOs and the sales and NMDCs and whatever they can then start selling down. It may be an interesting space to look at, because it's just completely beaten and neglected, very much like PSU banks. But here they are a completely different set of assets which strategics can buy, whereas in banking you may not be able to actually take out a lot of these PSU banks, which by the way are not doing too badly for themselves.
Percentage of your portfolio within the listed pool, Manish, is in banks right now?
All the financials. So I mean, I still love the capital marketplace because I know that space well. I love the banks because of just valuation, no other reason. Otherwise, I'm not really a lover of leverage. But I see the tailwind which they will get because of this falling costs. And I'm not saying it's happening in the next year or two, because I can afford to be as a private investor, take 5 years from now, will SBI and ICICI and HDFC and Axis and all these other banks, will they be around in 5 years? And will they be a lot more dominant than they are today? I think the answer is yes. And are the valuations aggressive today? The answer is no. So even if you compound 15% from here for the next 4 or 5 years, and you get slight amount of re-rating back, you're in business.
Manish, one of the key features about India is, the steady inflow of retail money, which we talked about. And that seems pretty much price agnostic. Do you think this domestic liquidity is going to A, continue to chug along in this fashion, and B, be enough to offset the FI's selling pressure, which also has been so persistent? Or is it creating its own distortions in valuations?
No, it's the nature of the animal that as long as there is momentum, and your NAV sheets show you gains, uh, momentum continues. And again, we're starting from a very low base. I think there's still maybe 30-35% of the assets of the banking sector. And over time, people should be in India allocating a lot more towards risk assets, and participate on the upside of India. But this price agnostic behavior that you have to make, 15%, 20% return every year is not a linear function in the stock markets. There are 2-3 years where you make a lot of money, and then there are a couple of years where you don't make, or you may, go sideways. Like it's been, for example, with the Indian rupee, it doesn't fall in a straight line. And then when you look back, you say, oh yeah, it compounded and it fell 4%, 5% kind of, over a period of time. And once it's fallen, then everyone rushes in to cover their exports. Whereas it's absolutely the opposite of what you have to be doing. And Sanjeev Prasad actually wrote a good piece recently where he said the almost 40% of the money which came into the markets over the last 2 years has not made any return because maybe they put in 1 lakh and 2 lakh crores in 21, 22, but then we put in 4 lakh crores in the last 2 years, and therefore you bought double the stock at double the price, and therefore it's taken your average cost of whatever you're holding that much higher, and taken away a lot of the excitement for a lot of the folios. So having said all that, look, I do think it's a 10-year trend that a lot of the youngsters in India are not going to keep money in fixed deposits and low yielding assets, and they would like to take risk, and it is a welcome thing. But I do think the constitution of this money can't be, buying at 50 and 100 multiples. And B, the constitution has to go a lot more towards what I call these IP, tech, and brand type companies, away from the processor types, which we've been traditionally. And the other big chunk of your portfolio, I would still submit, would have to be to hard assets, because what the US has unleashed in the world is inflation. And the Chinese are, of course, curbing their capacities. You put these two things together, a lot of the hard asset prices are going to go up because it's just a way of revaluing it against, the dollar and other currencies. The way gold and silver are getting repriced against the dollar, and they remain in a bull market.
So, Manish, let me twist the question around. Since you are a new grandfather, if you had to create a nest egg for your grandson to be given to him on his 18th birthday, given that you've spoken about so many cycles, importance of asset allocation, given where we are today with all the global money chasing AI, flows into hard assets, India looking relatively expensive, if you had to create a portfolio for him to be gifted on his 18th birthday, what would it look like?
So I'll say two things there. Number one, it's my son's problem, it's not mine. And number two, we do have a talk about it that I say, if you only transfer wealth, which is Lakshmi, you're doing a disservice, because like in the Indian pantheon of goddesses, you have Lakshmi, you
And
have
Saraswati.
Saraswati, which is goddess of wisdom and knowledge. And that's more important because where you lose the edge on knowledge and technology, you fall behind. And the third is EQ, which is goddess Durga,
Yeah.
emotion. And if you're not invested in each other as a family, then you fall behind. And that applies whether it's a country as well, right? We used to be the leaders in the world, and then we fell behind on technology, and a simple cannon against the Indian sword resulted in 1,000 years of slavery. Same way, what's going on now in this whole IT boom, by just being the providers of picks and shovels, we are not going to lead. You've seen the cards that China has, that the US cannot mess with them. And India doesn't seem to have any cards to play back. And therefore, we are dancing with China, we're dancing with US, we're dancing with Russia. Whoever wants to dance with us, we're dancing with them. But until we truly become like the Prime Minister says, Atmanirbhar, and have our own technology, uh, so long story short, as a family, we think a lot about technology. And from my early days, I used to be like a technology investor. And a lot of it now has to happen overseas. And I just hope a lot of Indian investors who only think India is the market in the world and nothing else, if they look and expand their horizons outside in the world, even if it's small amount of money, please go out, invest in the world, because it's inevitable in a few years, the rupee will have to be made convertible. You can't be the third largest economy with a closed capital account forever. And if Indians had been allowed, maybe we would have all owned large chunks of Nvidia and Amazon and Apple and Google and so on, and been bringing a lot of that FDI back into India rather than harping on remittances. We could have been bringing capital gains back to India. So it's like you started the show by saying there's a lot of change going around, and there are decades when nothing happens. I know people will laugh. I've been harping on privatization and rupee and all of that for decades, but I think change is in the air, and one should stay optimistic about this, and especially for the younger investors in India.
Absolutely. And I can say that there will be no dearth of wisdom, definitely, in the Chokani family for your grandson. You did dodge my question on what the portfolio is going to look like, but I'm going to catch you on that some other time. Always good having you in the show, Manish. Thank you.
Thanks for having me.
Thanks.
Thank you.
Bye. Okay, a lot of food for thought, and that's what you expected from Manish Chokani. Diversify, that's the key messaging. Build your portfolio aligned to tech with financials. We'll take a very quick break. We'll continue tracking markets on the other side.